Hello, I'm Dr. Sridhar Mote. As part of the lecture series on contract management for this YouTube channel, this is third in the series covering the lesson on general conditions of the contracts, the terms and conditions normally followed in construction contracts. With around 35 years of experience, years in government and 15 years in private, I have been teaching this contract management as a subject as a visiting faculty to the various premier and teaching and training institutes in Hyderabad. I also authored a book on contract management titled Infrastructure Contracts and Management, published by Asia Law House, renowned publishers. This is available in Amazon, amazon.in. So this third in the lecture series deals with general conditions of the contract. I'm showing you the glimpse of the book authored by me. This book covers numerous topics on infrastructure contracts and their management, including claims, dispute resolutions, ADR, Contract Act and Arbitration Act also is available in Amazon. The takeaways from this lesson are going to be understanding the special nature of construction contracts, standard terms and general conditions normally followed in construction contracts, special conditions of contract referred as SCC, precedents of the documents, what are the types of contracts, and also Fidic contract conditions. These are the expected takeaways from this lesson. Well, the construction and infrastructure contracts are different from contracts for sale of goods contract. Sale of goods contract in manufacturing sector follow a different analogy. Means first a product is manufactured or made. Suppose a car. First the product is made and it is costing is given. It is marketed and sold. That is a sale of goods, manufacturing sector. But in construction contracts, the analogy is product made and sold. Product is first sold in construction contract because in construction contract, the product is first sold means suppose there is a project of 100-member staff quarters to be built. Through a tenders, the construction of product making means 100-member staff quarters is auctioned and a lowest bidder is selected, say for a value of 100 crores. When the product is not made but sold before it is made. Then as per the specifications, drawings issued and the instructions of the owner, the product is made. So the analogy in this is product is first sold then made as per the requirements. Again, there is a difference in normal sale of good contracts to construction contracts. There is no standard form of contract documentation. In generally sale of goods or say a type of contracts, there are a standard set of work orders, but a contract document may be in different formats signed by different departments and the terms and conditions may also vary. So there is no standard format. Normally, the construction contract documentation consists of various documentations, various annexures. For example, in an item rate contract in a simplest form, the contract document may consist of letter of acceptance or a work awarding letter. It will be having normally conditions of contract, which may include certain special conditions of contract also. Technical specifications highlighting how to execute the technical nature of works. It will obviously in an item rate contract, it will have a priced bill of quantities, which is normally referred as a priced BOQ. Not limited to this, again, for different types of contracts, Suppose if it is an EPC contract, it may be having owner's requirements, tender drawings, and some payment schedules, annexures, so many things. So a construction document will consist of voluminous documents normally. Invariably, government departments follow a standard set of terms and conditions of the contracts, which are also called standard form contracts. For example, in CPWD or MES, Railways or National Highway Authority of India follow their department own specific terms and conditions, which are called standard form contracts, akin for their own departments. Let us see the general terms and conditions normally followed in construction contracts for better understanding. First, in any contract, in construction contract, the first chapter will be on definition of terms. Various terms are and terminology used in the contract document are explained, which will have a legal significance and meaning. Say they will define what is meant by a work, a contract, site, so many things. So each and every terminology or term used is defined legally, which has a legal interpretation. Again, it will have instructions to bidders, or called a bid data. Means what about the information given to bidders based on which the bid is made. It may be having certain project specific data or a site specific data. Also, it may be having what are the last date of opening of the tenders, where the tenders will be submitted, what is the EMD, and what type of bank guarantees to the performance are given. Likewise, it is called instructions to bidders or a bid data. Next, there will be in terms and conditions, which are called a general general conditions of the contract, are called a GCC. Invariably, this GCC will consist of conditions on commercial financial aspects like performance guarantee. The performance guarantee is a specific term in the construction contracts. Means when a construction is to be built, a infrastructure project is to be executed based on the contract. For performance of the project, means for building or construction, the contractor gives a guarantee so that he will fulfill all his contractual obligation in the contract. For this, normally 5% or 10% of the contract value is given in the form of a bank guarantee. If there is any performance lapse, that guarantee will be forfeited. Owner has right to encash the bank guarantee. So it is a guarantee against the performance given as a percentage of contract value. So a bank guarantee, the format is given. This is a specific provision in the construction contract. Terms of the contract will specify what are the natures of bank guarantee, how much percentage of contract value, from which banks it should be obtained. Likewise, it may specify the terms regarding the performance guarantee. Again, next set of commercial conditions in the GCC may be on retention. Means certain portion of bill amount is deducted and retained with the employer as a guarantee for the performance till the defect liability period. Means as a manufacturing product is having a warranty, the product being built or made, constructed should have a warranty that is called a defect liability period, 6 months or say 1 year. Up to that, the product should be having a worry-free or designated performance. For that, the amount retained or deducted from the bill kept with the owner. This will be released only after expiry or completion of the defect liability period. This is normally called a retention or a security deposit. As a percentage of bill, it is retained, means deducted and kept with the owner. Normally, it is released again as the bank guarantee of equivalent amount. Security deposit also as a term is also used for the retention, and the earnest money deposit, that is deposited along with the tender, is adjusted again as the retention. Normally, this retention may be specified as a percentage in the contract document, say 5% or say 10% of the bill amount is deducted and retained with the employer till the effect liability period is over. Again, the next set of financial commercial conditions can be on mobilization advance. Certain percentage of contract value is given as a advance to the contractor towards mobilization for the resources. Means when a work is awarded, the contractor using the amount given as an advance can use for mobilization of manpower, machinery and initial purchase of the materials, creation of infrastructure at the site. From the bill, the mobilization advance is adjusted from the bill amounts on a pro rata basis. Suppose 10% is given as a mobilization advance. From the bill amounts, 10% is deducted and adjusted towards this advance. So this is a mobilization advance. The terms and conditions eventually will specify how much is the mobilization advance is being given and how the adjustment will be made. Again, there will be terms and conditions on secured advance. Means during the execution of work, the contractor will be given advance against the materials procured and brought to the site. This will help in improving the cash flow conditions. Such advances will be given only for non-perishable materials. Means for items like cement, steel or aggregates, bricks, advance is given, and from the bills this advance sanctioned against the materials will be adjusted. Again, the general terms and conditions may be having the payment terms and bill certification. This also is a very peculiar and unique to the construction contracts. Normally in sale of goods contract, the consideration is paid on the receipt of goods. But here there is a concept of interim payment bills. Means the payment consideration is released periodically. In construction contract, the payments generally are made periodically, means every month. Say for end of the every month or in the first week, again as the work executed, the measurements are made and the bills are prepared and submitted to the employer, which will be certified by the project authorities or engineer in charge. That is called a bill certification. Eventuality, the bills will be paid as an interim payment bills or running account bills. These payments will be again adjusted and reconciled at the final bill stage. So invariably, the payment terms will consist about the running accounts bill, in which period the certification will be done, who will be the certifying authorities, and in how many days the payments will be made. All payment related terms and conditions, certifications of bills are covered in payment terms. These are also called interim payment certificates or interim payment or running account payments. Again, there will be terms on deviation limit. Specifically in item rate contracts, a quantity is given for an item rate trade. Item is given with a quantity and unit against which the contractor will quote his rates. So up to what, there will be normally some deviations and extra works, but up to what limit the quoted rate is valid. Suppose 100 cubic meters of concrete, I have quoted the rate. Up to what excess my rate is valid. So this deviation limit in item rate contracts specifies a percentage up to which the rates are valid. For example, for individual items, the deviation limit is 30%, means up to 130 cubic meters, if 100 cubic meter is there, my rate is valid. Over that, I can seek extra rate. So the rate is valid up to this deviation limit, which is mentioned as a percentage. Generally, for foundations, such deviation limit is specified as 100%. So for foundation items, 10% deviation is allowed. Generally, for item rate contracts, The terms in the deviation limit are specified in the contracts. Again, when there is a contract, obviously there may be certain extra items or beyond scope of works. Certain items may be having substituted items and out of scope items even in EPC or turnkey jobs. And how to execute that extra or variations out of scope works. And who is the authority to order such variations? What are the types of variations? If such variations are out of scope works, extra works, how the rates are to be paid, that is called a valuation methodology. These are all covered under the distinct terms and conditions under the head variations. This is a very important term in a construction contract which has to be studied extensively. Normally, construction contracts have price variation provisions which are called escalations. There can be contracts which do not provide for any price adjustment or escalation provisions. Means normally when a contract is quoted, in a long period contract, say 2 to 3 years contracts, the prices may vary, market prices of materials and labor may vary. So if some price compensation for the increase is provided, that may be giving a good advantage to the contractor. That is called a escalation or a price adjustment provision. Normally, it is based on a formula mechanism, the index and wholesale price index formula mechanism. And in subsequent lessons, we will exclusively learn about the price variation provisions followed in construction contracts. So, in a construction contract, whether it is a fixed price contract means price variation is not there, or if there is a price variation, how the price variation provisions are affected even under this terms and conditions specifically. Next, what is the time stipulated for the project? And in case of spillover, who is the person to sanction the extra items? What are the hindrances? What are the notifications to be given? Apart from the overall time period, there may be certain intermediate milestone also as a targets at the intermediate stages. All will be specified in time related aspects of the contract as a condition. It may be having intermediate milestones also. Now, in case of work cannot be completed due to whatever reason, then what are the eventualities of extension of the period for the time? Specifically, the contract provides for this. Again, every contract invariably may be providing for the liquidated damages. Means, if the work cannot be completed or delayed due to the contractor cost delays, a contractor will be penalized by a certain percentage of contract value for the period of delay period as specified in the contract document. It will be specified as a fraction of percentage of contract price for the period of delay, say 0.1% per week, or 0.1% of contract price per week of delay is levied as a liquidated damage. As per law, these liquidated damages are viewed as pre-estimated, genuinely agreed damages. We will study extensively in subsequent lecture series on these liquidated damages. So, invariably, construction contracts will have a provision and terms and conditions on LDs. These are the penalties or damages to be levied by the project owner on the contractor in case of delays caused by the contractor. Now, as a warranty for a product in a manufacturing goods sector, for construction contract also, there is a defect liability period. The product is built or made should not have any defect. Suppose I am constructing a building. The building should not leak or a crack should not appear up to a certain specified period, that is called a defect liability period. Normally it may be 6 months or 1 year, and there are certain performance obligations specified so that the product made, the construction project, should not develop any defect. So if any defect is there, it should be rectified by the contractor at his own cost. In case he fails, from the retention money or the security deposit retained from the bills, the owner has a right to get it executed and deduct from this retention money. So after successful completion of the defect liability only, the retention will be released. All these terms and conditions are mentioned under this. Again, there can be certain force majeure events or hindrances. Force majeure events are called acts of God, just like war, rebellion, epidemics, cyclones, hurricanes, earthquakes like this, wherein the performance of the parties will be affected. So for force majeure, the performance is excused, only the time is given, not the cost. So what are the events of force majeure? And these are given under a distinct condition. Also, in case of hindrances, how the hindrances are to be notified, likewise, and what are the types of hindrances covered, all given under relevant terms and conditions under this head. Again, the terms and conditions may also include notification, means in case of an extra item, the contractor is bound to give a notification to the project owner within a time period, or in case of claim towards any extra work, he has to give a notification. How the notifications and in what time periods the notifications whom to are given covered in this. Again, there may be terms and conditions regarding the what are the default events by the parties, by the contractor or by the owner. Suppose the owner defaults in payments for more than 6 months, then it is a default event. Or for certain contract also performance, there is a default events. Repeatedly, he is on giving notice also, he is not improving the progress or quality issues are there or he suspend the work. Then what are the events of defaults and in what events the termination of the contract can be made and what are the remedies, amounts to be adjusted against the termination, all are given in this distinct terms and conditions. Obviously, in a construction contract, there may be difference of opinions or disputes between the project owner and the contractor. In such an eventuality, how the disputes are to be resolved means there may be certain dispute resolution provisions. The contract means whether it is a multi-tier, means when the disputes are there, whether court is there or one can go for the arbitration, any alternative dispute resolution mechanism is there besides arbitration, how the disputes are to be redressed are mentioned in this. Again, there can be certain statutory provisions of wages and labor regulations, means as per law, the contractor has to adhere to the certain labor welfare measures and regulations, and he has to pay the minimum wages, fair wages. Likewise, all these provisions are mentioned, or the act's provisions are mentioned in certain contracts. Otherwise, also the contractor is bound to adhere to all these statutory provisions as per law. Next, the terms and conditions may include about the taxation and taxes. Who has to bear the taxes under the contract, whether the taxes are liable to be incurred by the contractor or say certain taxes are to be reimbursed by the owner, all will be specified in this. And also insurance provisions, means what types of insurance are to be taken by the contractor and what are the insurance provisions. Finally, apart from the general terms and conditions, there can be certain special conditions of the contract also, which are called SCC. Now, under this, so many types of document forming the part of the contract. If there is a difference or say ambiguity in different parts of the document, say in special conditions of the contract, a term say something, and in general terms of the contract, a term may define something. So if there is a discrepancy between two different types of documents on the same aspect, then which one will govern? So it is called a hierarchy or precedence of document, normally specified the tender in the agreement. In agreement, in case of discrepancy or ambiguity in different parts of the document about an aspect, then which one will govern? Which is the hierarchy or precedence of documents? Which document has the highest precedence? This is normally given in the contract itself. Normally, if there is nothing is given as per the industry standards, this is the hierarchy. Normally, this hierarchy is provided in the contract document itself. The contract agreement means signed on the bond paper of 2 to 3 pages is having the highest hierarchy in the order, top to bottom. Next hierarchy is letter of acceptance. Special conditions of contract has a higher precedence over general conditions contract because they are special conditions. Employers' requirements have even more precedence than tender drawings. Next in the order is tender drawings have precedence. Priced BOQ is having a next precedence over the technical specifications. Means if technical specification and priced BOQ there is a variance, then BOQ nomenclature has a precedence over technical specifications. As a just example, this precedence of documents or hierarchy is shown. Next, we will just try to understand what are the types of contracts. Item rate contract. In this, the design, drawing, everything, it will be supplied by the employer, and an item nomenclature is given for which the contractor quotes his rate. So this is a risk-free and a simple form of contract wherein the employer takes the responsibility of project scope of work and also the design and drawings, everything. So based on the drawings and specifications, the contractor will execute the work based on the item trade given in the priced BOQ. He will quote the rate for the items. In a percentage rate contract, the rate is not quoted by the contractor, but against the item, the quantities and the units, the SSR rate, estimated rate is given, and overall estimated cost is provided by the employer. Over the estimated cost overall, the contractor will quote as a percentage above or below the estimated cost total. Means a contractor is say quoting 5% above overall, means his individual quoted rate is for the particular item 5% above the SSR rate. So that is a percentage rate tender. In design and build contract, the design is in the scope of the bidder contractor. It is basically a item rate contract, but design responsibility is on the bidder. This design made by the contractor will be vetted by the employer. There is one more mode of contract called an EPC contract. This is an engineering procurement construction contract. In this, the scope of work is specified by the employer, and the total design and engineering, everything is in the scope of contractor who has to build the product and hand over to the employer based on the scope of work given. Design, engineering, and everything responsibility of the contract. In lump sum and turnkey contracts, just a lump sum specification is given for the product on a turnkey basis, means the product is to be built, and again installation, commissioning is also a responsibility. Generally for major projects it is done. Just like after a completion of all including testing and erection and commissioning, just put the key and start the operation of the project. That is called the concept. So everything is the responsibility of the project contractor. In cost plus contract, when the effort cannot be estimated, then when the tenders cannot be floated, in these eventualities, the contract is awarded in a cost plus basis, means all the materials and labor, manpower, machinery involved are accounted for, and the total cost is worked out as per actuals. over that actual cost incurred, certain percentage is paid as a compensation rate towards profit. That is called a cost plus contract model. In PPP model of contracts, which is also called public-private partnership, the project funding is done by the contractor. In traditionally, the project finance is the owner's responsibility. In PPP model, the contractor for building the product or for developing the project, he will arrange the finance through some bank loans or say from lenders. Again, he will operate the facility for a certain designated period and hand over the facility to the government at the end of the concession period. That is a PPP model project. When we are studying the contract standard form contracts, it is imperative to study have some knowledge on Fidic contract conditions also. Fidic is an acronym for French name called Fédération Internationale des Ingress Councils. In English, the meaning is International Federation of Consulting Engineers, which is located in Geneva, Switzerland. This organizes conferences, training courses, and workshops on contracts. Also, Fidic as a body publishes contract terms and conditions which are recognized internationally well for different contract models. These are most popular and worldwide internationally followed because it follows a fair, balanced, and equitable approach. It gives a very fair and equitable approach and good approach for both the parties. It is not biased or one-sided contract condition. In Fidic model contracts, there will be three parties. In traditional owner contractor models, there are only two parties to the contract, owner and contractor. In this Fidic model contracts, there is an engineer in between who will certify the bills and also who will measure who will issue the drawings, who will sanction in case of variations. An engineer is given authority in between in the contract, and he acts in between the contractor and the project owner. So there are three parties to the contract in a Fidic model contract. This is acknowledged as a fair, equitable, and balanced approach in contract administration. Also, Fidic has an advantage of dispute resolution mechanism. It is a well-structured dispute procedure for dispute resolution and to avoid and curtail disputes also. This Fidic publishes contract conditions where various types of contract models which are color coded. Say for item rate contracts, it is having a cover of red color. So that is called a red book for item rate contracts. Silver book is regarded as a contract conditions for EPC contracts, and yellow book for plant design, white for gold, white for the consultancy agreements, gold book for design and build model contracts, blue book, green books. You can just download a Fidic model documents and study the contract terms. And most of the last editions of Fidic were in 1999, and recently in 2017 revised suits were published for Fidic. Internationally, there are other contract model conditions, NEC, New Engineering Contract Conditions, which are formulated by Institution of Civil Engineers, UK, which are popularly used in UK, New Zealand, and Australia. Joint Contract Tribunal, UK standard form conditions for building projects. And also, as we discussed, there are standard form contracts followed in India by various government departments and organized departments like CPWD, MES, Railways, NHI. CIDC also has formulated certain standard form set of terms and conditions to be followed. For model concession agreements, Planning Commission has also formulated certain standard set of terms and conditions. So for better understanding, you are advised to study the conditions of contracts for different models so that one can make a comparison and contrast and have a better understanding about the terms and conditions for construction contracts. The more you have a comparison, you can understand better the terms and conditions applicable for construction contracts. For any support or help in management of infrastructure contracts, you can reach me at this email. Thank you. Keep watching this YouTube channel on the contract management topics, and also please popularize it. Thank you.